Hi everyone, welcome back. So today we will be breaking down a concept that every auditor or a CA student or CPA student must understand, and that is materiality in audit. And we will keep it very simple and super practical. So what is materiality? Imagine you are looking at a company's financial statements. You spot a mistake. Let's say rupees 50,000 is accidentally recorded as rupees 1 lakh. Now, does this matter? The answer to that depends on materiality. So, you need to ask yourself this question: would a mistake or omission influence the decision of someone reading the financial statements? If the answer is yes, then it is material. If no, it is not material. So, materiality is all about judging what matters enough to affect a user's decision. It could be an investor, banker, or regulator. So we have different types of materiality. First, we have overall materiality, also called planning materiality. So this materiality is at the level of financial statements as a whole. So if as an auditor, you determine that the overall materiality for a company is rupees 50 lakhs, it means that if there are aggregate misstatements or errors which exceed 50 lakhs, then the financial statements of that company could be misleading. So how do we calculate overall materiality? So the first step is to select a benchmark. So the benchmark is what the users care about the most in the financial statements. So it could be either profit, it could be revenue, it could be assets. So it varies based on the company. And next step is to apply a percentage to the benchmark. So the selection of a benchmark is subject to auditor's judgment, and there are various factors that can influence this. For example, what are the elements in the financial statements? What is the kind of business of the entity? Is there going to be a major change? What is the ownership structure? And also, importantly, what are the users of financial statements of that company most concerned with? So are they concerned with profit or revenue or assets or expenses? So typically for profit-oriented entities, the profit before tax is used as a benchmark. Now let's see what are the different benchmarks that can be used. So as we already said, if it is a profit-oriented company, then we select profit before tax as the benchmark. But what if it is a company that has recently started, startup, or if the profit is very volatile or it's a loss-making firm? Then we may select revenue or turnover as the benchmark. Then sometimes we have financial institutions or capital intensive companies. So in that case, maybe the users are interested in total assets. So that could be a benchmark. Similarly, equity could be a benchmark for investment firms. Or for non-profit, it could be the total expenditure. So it all varies based on the nature of company. And it is all subject to judgment. And you need to see whatever benchmark you select, it has to be stable and consistent year over year. So next question is, how do you decide the percentage that needs to be applied to the benchmark? So that depends on the risk profile of the client and it is subject to your judgment. But the thumb rule is, higher the risk, lower will be the percentage you will apply. This is because if the risk is higher, as an auditor, you will go conservative and you will want to have a very tight and robust audit scope. You want maximum coverage, you want maximum testing. So that is why a lower materiality is preferred if the risk is high. Now, how do you determine the risk? It is based on a lot of factors. What are the kind of internal controls? Are they strong? Then what is the volume of transactions? What is the complexity of the business operations? Are there any regulatory requirements? So there's a lot of judgment involved in determining the percentage. And another thing is, the percentage will vary even based on the kind of benchmark you select. For example, profit before tax, the typical range would be 5 to 10%. But for revenue, it is a lower range. Now, why is that? Because revenue is always higher than your profit. For example, in a company, we have a revenue of 2 crores and a profit before tax of 75 lakhs. So let's say if I choose profit before tax as benchmark and I'm taking 5% as the percentage, so the overall materiality in that case would be 3,75,000. Now, can I apply the same 5% or 10% to the revenue of 2 crores. If I do that, then 2 crores into 5% will become 10 lakhs. So it can overstate the materiality, which will unnecessarily decrease your audit efficiency. So that is why if the benchmark value is high, then the percentage would be low. For example, here it is 2 crores of revenue and the typical range for revenue is 0.5% to 2%. So in that case, I'm here selecting 2%. The materiality value in this case is 4 lakhs. So all these percentages are not prescribed or standardized. So it is completely based on judgment on the risk profile, on the type of entity. For example, a listed entity will typically have a lower range of percentage because it's more regulated and there's a lot of sensitivity to the slightest error. So for example, if the risk level is high, you could have a lower percentage like 3 to 5% of PBT. So what could be high risk indicators like weak controls, or if it's a first time audit, history of misstatements, complex transactions. Similarly, if it's a lower risk, then you could have a higher percentage of materiality like 7%, 10%. So it's all subject to judgment. Now that we saw how to select benchmark, how to apply a percentage, we can calculate our overall materiality. So let's take an example. Let's say there's a listed entity and it has stable profits year after year and no indicators of high risk. So let's say we have taken profit before tax as our benchmark and we are applying 5% to the benchmark. So if the profit before tax of that entity is 2 crores, then 5% of 2 crores is 10 lakhs. So that is our overall materiality. So once we calculate overall materiality, the next step is to calculate a performance materiality. So the performance materiality is always lesser than the overall materiality. So in fact, it ranges from 50 to 75% of the overall materiality. So let's say in this case, I'm taking 50% as performance materiality. So then planning materiality into 50%. So 10 lakh into 50% gives me 5 lakhs. So overall materiality is 10 lakhs and performance materiality is 5 lakhs. Now, why do we calculate this performance materiality? Because we want a buffer. We want to be more conservative. As auditors, we always do sample testing, so it is not necessary that all misstatements will be identified and detected. Some may just go undetected. So performance materiality is like a safety net. It helps to ensure that if there are any uncorrected misstatements, they will not exceed the overall materiality. Again, higher the risk, lower is the percentage of performance materiality. So for example, if I estimate the risk to be high, I can take 50% as performance materiality. Otherwise, we can even take 75% of planning materiality to be performance materiality. It's all subject to judgment. Also, performance materiality can be calculated differently for different parts of the financial statements, which means that it can be calculated at an assertion level. So on the screen now, you can see we have income statement, balance sheet. So there are different line items. So different types of assets. Then we have current assets, we have revenue, we have finance income, we have different types of expenses. So if one item is perceived more riskier than the others, or if the users are specifically interested in certain disclosures, then we can have a higher performance materiality for that specific item. So in our example, we calculated performance materiality as 5 lakh rupees. But if the risk is higher for certain items, let's say for revenue, then we can reduce this for revenue. So we can have a lower performance materiality of, let's say, 3 lakh rupees for revenue. So it is all subject to judgment. Now next step is to calculate the clearly trivial threshold. Now imagine you find a small error, say just 2000 rupees. Is it worth reporting? Probably not. So that is why we set a clearly trivial threshold. So this is a small amount below which we ignore errors completely. It could be 1% or 2% of the planning materiality. And why do we do this? So that we don't waste time discussing negligible issues with the client that won't affect anybody's decisions. But remember, if it is a fraud, then even 2000 might be material. So that could be qualitative materiality. Okay. Now, in our example, we saw that overall materiality is 10 lakhs. And then if we take 2% as the clearly trivial threshold, then our clearly trivial threshold would be 20,000 rupees. So now, continuing the same example, let's see how you can assess misstatements in relation to materiality. And you identify these errors. So we have an error in depreciation, which is of 2 lakh rupees. Then you have error in revenue, it is overstated by 50,000. So both of these are anyway exceeding the clearly trivial threshold. So you will accumulate these misstatements, which means you will total all these misstatements and assess if the total will exceed the materiality. Now, when we come to the third item, the third example we are taking here is that the employee bonus is overpaid. So it is 1,000 rupees only. This is below your trivial threshold. But what do you need to do? First, you need to extrapolate, which means whenever you do testing, you're testing only samples. Now you need to assess if in your sample itself you're finding an error of 1,000 rupees, what could be the projected error in the entire population. And if that exceeds your trivial threshold, then you can accumulate that too. So always, for all the misstatements, we can extrapolate and then assess and compare it with materiality. So all the misstatements which are above the trivial threshold are accumulated, they are evaluated for the impact, and then you are supposed to communicate them to the management. So if the management rectifies these misstatements, then great, problem sorted. If these misstatements are not corrected by the management, then as an auditor, you will assess them for materiality. Is the total of the misstatements exceeding the materiality? Then if yes, it can lead to modification of opinion. Now, practically, sometimes as an auditor, you may also have to calculate materiality before the financial statements are available or before the period closes. For example, a company follows the calendar year January to December. The financial statements may be released and publicly available only in April. But as an auditor, you need to start your audit from April, so you would want to plan your audit beforehand and you have to calculate materiality as well. So in that case, you may calculate materiality based on prior year figures or annualize your year-to-date numbers. For example, if Q3 profit before tax is 6 crores and you expect the full year profit to be 8 crores, then you're using 8 crores for calculating your overall materiality. But you may need to adjust this later if the actuals differ significantly. So if the actual profit is higher or significantly lower, then you can reassess what is going to be your benchmark and apply a percentage and calculate the materiality. So I hope this was helpful, and don't forget to subscribe so that you can stay updated for more such content.